Hello, Marc from ADM Investor Services International, with some observations about, I think, the things which we need to start thinking about more as we approach the end of Q3, now that we're past Labor Day, and start to look at Q4 and the fact that we're going to have to start taking some rather more serious decisions as investors, and indeed governments will also have to address a lot of the longer term damage from the COVID-19 virus. So my first chart today is the S&P 500 with volumes at the bottom. I only mention this because obviously we've had a bit of a wobble in financial markets, largely driven by overweight positions in the tech sector. If one looks at traded volumes in terms of the sell-off thus far, they've been actually quite modest relative to spikes we've seen, though notably if one looks back at February, March time, obviously there was a little bit of a lag there before volumes caught up with price movements. And secondly, I think the observation is a very simple one. We are barely below the levels that we were at the peak, the previous high that we saw in February. So this is hardly tragic. It's more of a correction at the moment. I'm not going to prejudge it. How do things actually look in the corporate world? Two things I think are worth watching very closely now. First of all is unemployment. My second chart is US permanent job layoffs versus temporary layoffs. As one can see, temporary layoffs have improved markedly over the last four or 5 months. Which is a great relief, obviously. But on the other hand, the number of permanent layoffs is also accelerating, and this is something which we're going to need to watch very carefully. It also is the reason why we are so concerned that the Senate and the House of Representatives in the United States are still struggling to come up with some sort of additional COVID aid package, a lot of which will involve trying to support those on temporary layoffs. How does the picture look elsewhere? Well, let's take Germany as just one example. The third chart I have today is the German unemployment rate, which has spiked somewhat, but nothing like has been seen, say, in the United States or indeed in France or Spain. But on the other hand, that's not really a proper measure of what's going on with the labour market. One can see the other part of this chart is the amount of short-time workers in Germany. And as much as this is slightly out of date data because it's for June, it's still extraordinarily high, even in comparison with the 2007-2009 crisis. So there are problems there as well. I won't go into too much detail on insolvencies in Germany simply because basically they've been put on hold. So we've got a lot of zombification going on there. In the United States, the picture is somewhat different. They have a different process, obviously, the Chapter 11 process. So my fourth chart today is of the US Chapter 11 filings, which at the moment are hardly at the sort of levels that we saw back during the financial crisis. Indeed, we've had a few spikes higher in the meantime. But nevertheless, the trend is accelerating very rapidly, and some of these filings are actually for very large companies. The picture there is one, I think, which will have to be very, very closely watched, particularly if the government withdraws a lot of support for the corporate sector. My final chart relates to the United Kingdom, and that is basically following the news this week that we've sum totaled something in the region of about 50 billion of state-backed corporate borrowing. However, round about 1/5 of those people who have borrowed money on state-backed loan schemes are companies, I should say, are not expecting to be able to pay them back, which will probably also result in a lot of job losses. So there are quite a few challenges coming up ahead, and they're coming up fairly immediately. And I think these are the things which people are going to need to look at far more closely as we go into the end of the year. Those are the thoughts for this week.